few days ago, I had made a video about how to trade trading ranges. One of the topics I discussed in there was going for a scalp with a small profit and putting your stop far away, allowing yourself room to scale in. And Mithun is a viewer, and he wanted to see if I could make a video on specifically that, on how to manage it and how to take the trade. So that's what I took here. What I had done, I shorted down here. So what had happened, the market had 8 bear bars in a row. 3 of the bear bars being very large. This is the largest spike of the day so far. So I sold on a small pullback here. And there are 2 scenarios that are going to happen. Either the market continues going lower and we'll get the second leg that we're expecting, or market will pull back and will most likely be able to let the bears out that we're shorting. So first scenario, if we short here, maybe there's a little bit of a pullback and then the market gets a second leg and goes lower, tries to test the low of the day or maybe the high of the prior day. That's the first scenario. So the first scenario, it's good. We make money, no issues. Second scenario is the market pulls back and we have to manage the trade. So first thing, when you're taking a limit order scalp like this with plans of having a stop far away and scaling in, is you need to trade small. So what is small? Maybe it's only like 1/20th the size of your normal risk. Maybe it's 1/50th the size of your normal risk. So perhaps if you normally trade 5 contracts, then you should be going down to just 1 micro contract, right? If you really want to be risk averse and trade conservatively, if you're doing this. So in that trading range video, I was discussing oftentimes you need to put your stop like 30 points away or so. So in this trade, sold here, and 30 points away is actually way up here. It's almost off my screen there. And so you need to be able to trade small enough so that if you end up really actually losing those 30 points, that loss would be no greater than your normal risk. Okay, you need to be able to trade small enough so you're not going to be emotional. You wouldn't be uncomfortable with that kind of loss. So I'm shorting here, and the second scenario, like when it does pull back, I'm looking to scale in. The bears that are shorting here, most of the time, they'll be able to at least avoid a loss. So this is near the bottom of a trading range. It would be okay to avoid shorting down here. I think most traders probably should avoid shorting down here. But it still is likely that we'll get at least a second leg down off of this, or at least be able to avoid a loss if we're shorting here. So shorted here, as it was pulling back, areas that I look to scale in on. 2 ways you can do it. One is based off the previous price action. So based off of that, I would be looking at like this low here. There were probably some buyers below this bar. And as the market is pulling back, the buyers that had bought below here and bought more lower, they're getting out of their position here. So you have people that are long that are getting out of their long positions here, and they're selling. So there's a chance that a pullback would come from here. So I sold here. It's also right at the moving average, so possibly see some sellers there. The next time I shorted was above the high of the recent bear spike. So 3 strong bear bars. Market often likes to go to the top of a spike like that and then reverse down. So I added onto my position and shorted there. Now, normally if you're getting this much pressure against you, it's best to just go ahead and try to get out break even or get out with break even plus a couple ticks. And that's what I did here. So I just got a couple ticks of profit from this. And so this was the scenario where you have to deal with this pullback and then just try to get out and avoid a loss. Right. So as we can see, bears have just given up on trying to make a profit, and they're just looking out to get out, break even now. So one way to scale in is what I just described, looking at the price action to the left and scale in at key levels. Or you wait for a bear bar to sell below. So if I had done that here, let's say I sold here, sell below a bear bar, and market nearly got back to that. And often, if you're not able to get out initially on this pullback here, what will happen is this actually will create a measured move up, and then you will find your next bear bar to sell below somewhere in this area. It's a little skewed because this is such a large bear bar, so this is kind of a different case. But oftentimes you'll see that where you have your first bear bar, and then when your second bear bar does not work, then your third bear bar will end up being around a measured move up. So all that being said, the most important points are to trade small, so that when you have a stop far away, that your loss is no greater than any other trade. That's really the critical point. I think for beginners, it's better to stick with swing trading. And as they get more advanced, then they can take advantage of opportunities like this. When the market is going against them, for beginners, it's just going to be too difficult to manage it correctly, and emotionally, it's just going to mess them up. So as you're trading, think about this and see how you would trade it and manage it. And that'll just be good practice for you. All right, guys, thank you for watching. I hope that video helped. See you next time.